Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Well, it's hot off the press. Prime Minister Mark Carney just presented his first budget to the House of Commons this week, which lays out spending of $89.7 billion over the next 5 years and roughly $56 billion in savings from cuts to public service and program spending. Finance Minister François-Philippe Champagne has stated that the budget could entice $1 trillion of investment into the country. I'm Danielle Neziol, VP of Online Distribution at BMO ETFs. I'm so excited today to discuss what this budget means for Canadians and Canadian investors. And to help me break it all down, I have Larry Berman with me from ETF Capital Management. Larry, it's always so much fun to talk politics with you. Thanks for joining us.
Well, my pleasure, Danielle. And if I can say this, because I've said it many times on BNN, as future finance minister in Canada, I do have some very strong views on budgets and how governments really have handled our tax dollars for decades now. It's something that's motivated me to really take more of a political interest this late in my career.
Well, I can't wait to get to those insights. But before we get started, I just want to remind everyone today, Larry and I were not providing any investment advice or investment recommendations. Today's show and all our shows are about investment education for the Canadian do-it-yourself investor. Okay, Larry, let's get started. First, I want to talk about this. This budget was really Carney's response to the trade war that's happening with the U.S. So what are your thoughts around this proposed budget? Will it lessen the current trade war and the subsequent tariffs impact that they're having on Canadians and Canadian industries?
So there's a couple aspects that we can unpack here. One from the U.S. side, the case is in front of the Supreme Court now, whether these IEEPA-based tariffs are actually legal. And if you look at the poly markets, a week ago, they were 50-50 as to which way it can go. After some briefs today that were given in front of the Supreme Court, poly markets now have only a 25% chance or thereabouts, the last time I looked, that the Supreme Court would actually say they were legal. So while there are other avenues for the U.S. to claim tariffs, there's a lot of uncertainty still. And all the agreements, if you look at all the agreements, quote unquote, that they've made with leaders all over the world, none have really been ratified. Like there were an agreement to agree. And I think most countries are slow playing it because they realize that the approach that the president's taken is not quite on the up and up in that sense, that it's not a national emergency. So there is a chance that these tariffs get rolled back. It'll be interesting to see how that plays out. But let's assume for now that the tariffs are going to be in place and this is going to be a more permanent relationship with the U.S., then yeah, Canada needs to do something about it. And there's some aspects of the budget that certainly address that in terms of opening up Canada to the rest of the world for more trade, so that would offset any negative headwind from Canada. But U.S. are always going to be our biggest trading partner, given our proximity to them, and that's no deal anywhere is going to really change that.
Let's talk about the $1 trillion investment that Champagne is quoted as saying this budget's going to spur this $1 trillion. What areas of the Canadian market could potentially see that investment? And can corporate Canada really meet this prediction? Can they step up to the plate here?
So, I was super critical of the Trudeau government in terms of downplaying and underinvesting and putting more regulatory hurdles around some of Canada's best assets. And we all know that is oil and gas for the most part. Canada has suffered a bit of a brain drain to other places in the world where there's better business conditions. So some of the things in the budget are certainly trying to address that, improving corporate tax rates. I really like the idea of separating an operating budget to an investment budget, because someone coming from the investment side of things in the last almost 40 years of my career, I think about things as what must you spend money on to keep the lights on versus what should you invest in to keep the bill lower in the future. So, running deficits is a prudent thing to do when that fiscal spending is a real investment. So I do like the fact that they're trying to separate operating budget and balancing the operating budget of Canada to the investment climate, which is where the deficits would come. Now, I don't know if I was running a foreign corporation in the oil and gas space and the current administration said, no, no, build an LNG plant. We'll run the pipelines so you have capacity to stay in business. I don't know if I would trust them anytime soon. So I think it's going to be a slow moving ship in the sense that, listen, build it and I'll come, right? Right. So that whole build it and they will come thing, we need to make that investment now. That investment's measured in not weeks or months or quarters as earnings are focused on, but in years and maybe decades into the future. So Canada's got a black mark on it from an international perspective as a place to invest because of the last Liberal administration. I hope Mark Carney understands the difference and does take us in a different direction.
Let's pivot to the deficit. 78 billion deficit. How does this compare to past deficits? And what are your thoughts around the Liberal Party trying to shrink the deficit a little bit?
So the markets always say, well, what was priced in and what was expected, and then what actually happened. So there were rumors that it was going to be $100 billion deficit, so better than the worst case scenarios, but they were promised to be under the last administration closer to the 40 billion mark. So, the 78 billion kind of comes in the middle. They kind of distinguish different packages of spending around investment versus operational efficiencies, right? I've always said, as maybe future finance minister of Canada, put up your hand, ladies and gentlemen, if you want to vote for more efficient government, right? Like, there isn't a hand in Canada that shouldn't go up when you make a statement like that. And so if they're going to, through attrition and other methods, make the Canadian government more efficient, I'm all for that. Again, to be determined whether they can actually pull that off or not. But the 78 billion and how they spend it, there's good and there's bad things there. There are a few things in there that not happening, but some of the headlines, well, 40,000 jobs are going to be taken out. I think it should probably be double that amount. But again, I'm talking from an outsider's standpoint, not having looked at the books and seeing what's able to be delivered. Attrition is probably the best way to shrink government and make it efficient. And that way, you're not really laying any people off. You're just making it more efficient as your labor force tightens up a little bit. So hopefully, we get a little bit of both. The 78 billion number, like, it's a headline, right? When you look at the numbers and you look at the federal deficit as a percentage of GDP, we're running in the low 40s. Now in Canada, compared to the US, where it's 120% of GDP, but we have to add in the provincial government debt too because of the way transfer payments work in Canada. And if you take that, we're at 100% debt to GDP in Canada. So while the federal burden is not as bad as it appears to be or as they're painting it, the reality is the government burden in Canada is still pretty astronomical. And so when you look at, well, what is the annual cost to the taxpayer of funding that debt? Fortunately or unfortunately, the Canadian economy has been very weak over the last year. Interest rates have come down. So as they're rolling over the debt, the cost of refinancing is going down. So that number is very manageable today. In the US, that number has gone up pretty significantly in recent years because interest rates have normalized for inflation concerns. But if the Canadian economy, and in this budget, they're estimating 1.2% GDP for the current fiscal year, and for the back end years, somewhere around 2%. Like, we hope those are the numbers, because if we miss on 2% growth, and we only get 1% growth, that adds another 5 or 6 billion a year, right? If we exceed the 2% growth because we're making good investments in infrastructure and job creation, etc., the benefit to falling interest rates really only benefits the Canadian economy a little bit. So are you going to run it hot or cold? There's a lot of unknowns when you talk about that number, what it means over the 4 or 5 year horizon that they're looking at, the annual spend. So there's a lot of moving parts, and they'll change in real time as we get more, feedback based on how they're spending money and is it working or not. I'd like to think it will. There are aspects of the budget that I would probably do a little bit different if it was my budget, but I think we're moving in the right direction compared to the previous Liberal administration, who I think completely and utterly wasted colossal amounts of money for Canadian taxpayers.
Okay, let's come back to that 40,000 public service cuts that you mentioned. You mentioned also the Canadian economy is weakening. So those cuts, is that going to have a material impact on unemployment numbers in Canada? Is it going to materially impact our economy or weaken our economy?
When you look at the stats can forecast every month on what the job growth is or losses in Canada, it's been incredibly volatile the last year. You're getting 50, 60, 70,000 jobs one month, and then you're losing, 30, 40 the next month. The standard error on the estimate of jobs is more than 40,000 a month. So in perspective, 40,000 is not even a rounding error in that sense. So I don't think it means anything at all. If you think of the Canadian economy, 40 million people, if you think of the workforce being a little more than 22 million-ish, I don't know the number exactly, but in terms of the labor force, what's 40,000 in that context? And it's really a rounding error. So while it makes headlines, I don't think it means all that much. And again, who's for an more efficient government? Put up your hand.
Right. Good perspective there. And as I was reading about the budget, it sounds like some of those 40,000 will roll into retirement. So, Larry, I know we haven't had a lot of time to really digest the budget. It was just announced. But what are your initial thoughts on, will it have a material impact on the Canadian stock market? And what industries or companies do you think might have some tailwinds from what has been presented?
So about the deficit that they're talking about spending over the 4 years is infrastructure. Maybe it's 40% on. So you look at a Stantec or a name like that would benefit from a lot of infrastructure type support. But Canada really doesn't have a lot in terms of TSX listed companies that would benefit from that, because when you make up our index 40% financials in the TSX, well, none of this spending really translates into what's going to improve a bank's bottom line, right? Like there are other things that would. Obviously, a strong Canadian economy, if we invest and spend well, will benefit the TSX overall. But when you look at consumer, when you look at healthcare, when you look at the aging demographic of North America and Canada, the TSX doesn't have a lot of that. When you look at what's led world markets in terms of rallies in the last number of years, technology, we have a couple of names on the TSX. So Canada's not a great market, and while this spend will be great for Canada overall, in terms of potentially job growth and support for our economy, I don't think it's directly translatable into the TSX, right? And into the constitution of our marketplace. Having said that, if they're really serious about oil and gas, then pipelines come to mind. So yet to be proven and determined whether there's going to be enough of an infrastructure spend on pipelines to getting an east-west corridor done, to getting more capacity so we can actually sell our LNG to other places in the world like Europe and Japan that need it, where President Trump down in the States is like, no, we don't need anything from Canada. We're going to tariff your oil. Like it's hyperbola, and it's just, yeah, you smile and laugh because it's laughable. And some of the things that comes out of the president's mouth, tariff our oil and gas. Come on.
Thanks, Larry. So are you kind of saying that the infrastructure companies that could benefit from this increased spending in infrastructure are foreign companies? They're not Canadian companies?
No, not necessarily. Like part of the budget, for example, on air defense, so our NATO commitment and making that aspect. Canada doesn't produce bombers and F-18s or whatever the current number is on a jet. So they want to build those industries here. Okay, so how long does it take to build an airline defense industry? A decade, 2, 3, right? So perspective. And so while, yes, we'd like to create more things in Canada to produce that would benefit from our NATO spend, reality is there's nothing on the TSX today. I'm drawing a blank on the name of that company, but there's one on the TSX that kind of falls into the aerospace sector, but it's more like training. It's not really, what is it, Stantec, that built the Canadian arm. Like maybe there's this much in there, what they could benefit from. So the answer is it's very, very small today. And so again, building a road, not a lot. Building a bridge, not a lot. So that infrastructure spend, new housing development, again, what company listed on the Toronto Stock Exchange is a builder like you would have in Pulte Homes or something in the US where they've got, I don't know, a couple dozen home builders, right? We have REITs, but that's not the same here in Canada because they're not actually building the properties.
So it sounds like the budget's more so there to buoy the Canadian economy versus helping individual companies trading on the stock exchange.
So that's my interpretation of it. I could be proven very wrong, but in the last 24 hours since the budget dropped and had a chance to digest the information here, and I looked at what's going to win. For example, in the U.S., if they rule these tariffs to be illegal and he can't get any tariffs in under any of the other proposals, I'm not saying that's going to happen. The question is, well, what company is going to benefit that trades in the U.S.? Well, think of any retail sales company that has products coming from Asia that they're producing abroad, right? Well, maybe that's true for Canada. Well, but we're not tariffing, here in Canada for products built in Asia, right? So again, when I look through the budget and I look through all the sort of the implications currently geopolitical, I just don't see a lot of benefit that would accrue outside of maybe pipelines and some companies there that would be building them if we were really going to ramp up some capacity again east to west and out to the coast so that we can get our landlocked gold here in Canada to market.
Thanks, Larry, for your insights. Sounds like still more to come. A lot needs to shake out as the economy digests this new budget, but always great to have you on the show and talk politics and teach us a little bit about what's going on in the Canadian economy. Thanks for taking the time, Larry.
Thanks, Danielle. I look forward to seeing you in Ottawa next time I'm there.
And I look forward to talking maybe about your budget one day, Larry, on the show.
Well, I do need a new pair of shoes.
Okay. Well, that's it for us. ETF Market Insights. Thanks for tuning in, and we'll see you next week.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, Visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.